These are the top 8 sectors seasonally speaking: tech, hardware, semis, ground transportation, aerospace and defense, life science tools, metals and mining, oil and gas consumables, and biotech. And as I've said before and many times in the past, a continued rise in precious metals is not sending a great signal for equities for multiple reasons, but part of it, of course, is it's a vortex for risk appetite.
Markets are not in a bear market, yet many investors feel like they are. Year to date, the S&P is marginally positive, up roughly 1%. The trend, when viewed objectively, is still higher, and yet sentiment is heavy. Positioning is defensive. Investors are uneasy. Gold has rallied so strongly that its total market capitalization now exceeds that of the S&P 500's Magnificent Seven combined. That comparison is symbolically powerful. For years, the Mag 7 represented growth, innovation, and dominance. Gold, by contrast, represents safety, protection, and risk aversion. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
So let's talk about macro. I think there's 7 reasons why it feels like a bear market at the moment. Year to date, the S&P is up 1%. And as you can see, looking at this chart, it is a little jaggedy, but the trend is higher. But here are the reasons why I think it feels like a bear market. First is that gold has done so well that it's created FOMO, or fear of missing out. Here's the thing. Gold has actually done so well, and it's partly because geopolitical risks, that it's now larger than the S&P 500 in terms of market cap. So the S&P X Mag 7 is actually smaller than the gold market. And as I've said before and many times in the past, a continued rise in precious metals is not sending a great signal for equities for multiple reasons, but part of it, of course, is it's a vortex for risk appetite. The second is there's been a rotation in what I call armies versus bullets. The armies are the Mag 7 and the bullets are the AI suppliers. As you can see, markets have rotated from favoring armies, which are the companies that have great businesses, to the arms makers. But here's the thing. We've now created a valuation discrepancy. In the past, the armies always traded at a premium to the bullet makers. But as you can see, in 2026, that has flipped, and now the armies traded at more than a 3-point PE discount to the bullet makers. Does that make sense? I don't know, but here you go. You can see, if you look at the bullet makers, semis, power generation, and infrastructure now trade at higher PE multiples than the Mag 7. I think there's going to be a rotation back later this year, and so you have to be mindful of that. The third is that AI continues to be roiling sectors. It's, I guess, AI rampage. The latest being software. And keep in mind, people had talked for years about software eating the world, but now AI is eating the software industry. And so I think investors are taking a fire aim ready approach, meaning they're first selling everything before they decide if they actually want to buy anything. And keep in mind, there are AI resilient stocks out there. So software has fallen to the lowest prime brokerage exposure ever, according to Goldman Sachs. Crypto's also been under pressure. A lot of that has to do with the outperformance of gold and risk appetite. The Fed, with the new Fed chair, the market's trying to understand this new Fed chair, and I'll talk about it in another video, but the market always tests a new Fed chair as well. Tangentially, keep in mind the Epstein files, I think, have continued to sort of remain a headline story, and it's creating a lot of high-profile embarrassments. And of course, most recently, private credit is again resurfacing because of some of the concerns about companies like Blue Owl, and people believe there's echoes of the GFC. Now, something that is roiling markets, but I don't think it's making it feel like a bear market, is the tariffs. The Supreme Court, not surprisingly, overturned Trump's tariffs, and President Trump, in turn, is actually implementing, well, originally a 10% tariff, but now it's 15%. And he has authorities to actually levy tariffs, so it's not like it's going away. So now let's talk about the granny rebalance, because that happens every 3 months, and we just had the latest rebalance. Okay, this was executed on February 18th. So it happened last week already. Now let's start with Granny. This is both Granny and Granny income. The top 3 sector weights remain in tech, industrials, and financials, but the weighting has shrunk a little bit from 74% to 60%. But what has increased is energy, materials, and healthcare. They were actually 0 weights in Granny income before, but now they're 8, 7, and 3%. So they've gone from 0 to 18%. For Granny J, industrials, information, tech, and financials were originally 74%. They're now 63%. And energy and healthcare were 8% in the portfolio previously, and they're now 16%. So that's really where the changes have taken place. It's energy and healthcare and materials. Now, these changes are not taking place because of the macro themes of energy / cybersecurity, millennials, global labor suppliers, or easing financial conditions. It's really because of style tilt, seasonality, and the PMI recovery shifts. Okay, and these rebalance every 3 months. For instance, in terms of style, previously we were recommending quality growth and quality cyclicals. Now it's actually value quality and quality cyclicals. Okay, and so that's what we think will outperform the next 3 months based on our analysis. These are the top 8 sectors seasonally speaking: tech, hardware, semis, ground transportation, aerospace and defense, life science tools, metals and mining, oil and gas consumables, and biotech. You might think these have already done well. That's true, but this is the seasonal pattern. And that leads to both deletions from our portfolio, which were done on February 18th, and additions. So let's look at the additions. Chevron, this is for large cap. Chevron, Union Pacific was added. Texas Pacific Land Corp, One Oak, Amgen, Air Products, Packaging Corp, PPG, Northrop Grumman. Now on SMID Granny, there were a lot of 11 removals, which is a lot, and 18 additions. Okay. Carpenter Technologies, Curtiss Wright, Exelixis, Halozyme Therapeutics, Valmont Industries, Array Technologies, Fabrinet, Hyatt Hotels, Domino's Pizza, Elf Beauty, Carrier Global, United Health Services, HF Sinclair, Huntington Ingalls Industries, DT Midstream, Energy Fuels, Lattice Semiconductor, EchoStar. And that's it. Now, let's talk about Granny stock performance. And rather than talk about the individual names, I want to talk about the themes that outperformed this week. Number 1 was energy and cybersecurity. Number 2 are millennials. And number 3 is the PMI recovery. As of February 20th, the price of Granny, ticker GRNY, was $25.05, NAV of $25.05, and total assets of $4.15 billion. For Granny J, or the small mid-cap Granny, the price was $27.80, NAV of $27.83, and total assets of $391 million. And for Granny I, which is the income-oriented large-cap Granny shots, the price was $20.15, NAV of $20, and total assets of $58 million. I want to talk about year-to-date performance. Year-to-date, Granny shots is up 1.18% compared to 1.11% for the S&P 500, or relative outperformance of 7 basis points. For Granny J, year-to-date performance is 8.96% compared to 8.5% for the Russell 2500, which is 39 basis points of outperformance. And for Granny Income, the total return is plus 0.28%, compared to plus 1.11% for the S&P 500, or underperformance of 82 basis points.
Year to date, performance remains steady. The flagship large-cap strategy is up slightly more than the S&P 500, outperforming modestly. The small and mid-cap sleeve is outperforming the Russell 2500 by a wider margin. The income-oriented strategy has lagged somewhat. These are not numbers consistent with a collapsing market. They are numbers consistent with rotation, dispersion, and internal reordering. And that distinction is critical.
Bitcoin dominance has been a really interesting topic the last few years. Many of you probably listened to at least a few of the videos I've done about Bitcoin dominance over the years, and I would frequently say that Bitcoin was a better investment than altcoins, for several years, because Bitcoin dominance was essentially in this macro uptrend. All right. Now, one of the things that I frequently wrestled with was dealing with the idea that people thought that whenever Bitcoin dominance does find a local top, that doesn't necessarily mean alt season has to happen right away. And this was something we talked about at length, and we really looked at it more closely when looking at it through the lens of total 3 minus USDT divided by Bitcoin. And so what we said was that, look, when, by the time this thing gets down to the range lows, when it did that in 2019, Bitcoin then went into a bear market. So why are people expecting Bitcoin to not go into a bear market as it gets down to those range lows? And if you look here at the drop that we had in October, where alt Bitcoin pairs hit around 0.29, if you include USDC, they actually went down to 0.25. But if you look at it like this, one of the things you might notice is that that's essentially when the bear market started, when all Bitcoin pairs had this major capitulation near to where they've had those capitulations in prior cycles. If you look at this chart and we include USDC, which is something we've mentioned, you can see the wick actually went all the way down to 0.25, right? Now, there's a good chance eventually this thing will go lower, because as I've said before, altcoins are oscillators at best against Bitcoin. Now, what's essentially going on is last cycle, alt Bitcoin pairs started to, we want to look at total assets held by the Federal Reserve. Alt Bitcoin pairs last cycle started to show a little bit of strength after quantitative tightening ended. And you can see they actually went up for a little while. But what's interesting is that they still eventually capitulated to new lows in the next Bitcoin bull market. And that's the important piece that I think people should remember, is that while alt Bitcoin pairs bled for years, even by the time they started going up, they initially started going up because Bitcoin was dropping more than the altcoins. Why was Bitcoin dropping more than the altcoins? Well, the altcoins, frankly, had already been annihilated in the bull market. And we've talked about that many times. A lot of altcoins that were, some major players in a prior cycle, they're already at their 2022 lows. So when you have altcoins bleeding to Bitcoin year after year after year, and then Bitcoin then finally goes into a bear market, then you can see alt Bitcoin pairs sometimes go up even while they bleed on their USD pairs. If you follow me long enough, you'll remember one of the things I said. And what it was, what I said was that alt Bitcoin pairs bottom first, alt USD pairs bottom next. Now, what's really fascinating about the Bitcoin dominance chart to me, what's really fascinating is, this is the stablecoin dominance. If you look at Bitcoin dominance, you can see that it has in fact been kind of steady for a while. We talked about how September could be a pivot point for Bitcoin dominance and how usually it starts going back the other direction out of September, but it looks like it sort of stalled out. Now, what's interesting about this chart, and we're going to dive into this, what's interesting about this is if you only looked at that, you might think that altcoins are outperforming Bitcoin collectively, at least the last few months. What's interesting, though, is if you look at total 2 minus USDT divided by Bitcoin, you can see that it's been bleeding since September. So why is it that this chart has been bleeding, but then Bitcoin dominance also seems to not be going up, right? If all Bitcoin pairs collectively are going down, then Bitcoin dominance should theoretically be going up. What's happening when we're looking at total 2 minus USDT divided by Bitcoin, you're not looking at like all the stablecoins in this chart. You're not looking at all the stablecoins in the chart.
Gold strength, AI disruption, valuation flips, Fed transition, private credit scrutiny, trade uncertainty. These forces create discomfort. They distort leadership. They shake confidence. But the index trend remains higher. Markets can feel bearish without being bearish. They can rotate violently without collapsing. They can test conviction without invalidating the cycle.